Nice to meet everyone, and I'm glad to be here. Thank you for the invitation. My name is Eric Evans. I'm based here in Boston, where I am an early stage venture investor. I used to be a scientist. I was a physicist many years ago, and then went into business. I have run a few companies, and now I'm a full-time investor. I've been doing this for years, and I thought I might be able to help you think about how you'll get the money you'll need to launch a company if you decide that's what you want to do with some of your great discoveries or inventions. Because you know the old saying, it takes money to make money. So I'm going to help you figure out how to get some of that money. Now, you may not be ready yet. I understand that the audience is at different phases of their research. So it might be that this is something you'll do in 2 years or in 3 years. But I thought it'd be helpful for you to know how you're going to do it from the venture capitalist perspective. And a lot of people you'll see have opinions on how to pitch, what a pitch deck should look like, and so forth. But I do this for a living, and I've been doing it for a while. So I hope my opinion might be a little bit more useful than most. So let's see what we're going to do today. First, I'm going to talk about the funding model. How do you fund a startup company? What's the world like outside of grants? How do you approach angel and venture capital investors? I mean, this is presumably not your world. How do you get started? How do you find them? What do you say to them? What are they looking for in a pitch? You've heard a lot about this probably. I'll try to be somewhat disciplined in my advice. And then some final points if we have time. I've only got about a dozen slides, but I typically take about 40 minutes or so to deliver them. So if we take an hour, that's questions at the end, but also please feel free to interrupt me as we go. And I'll try to hit that mark at 4 o'clock in any case. So these are the things I'll cover. And let's start with the funding model, which you may or may not have some familiarity with. This is what I would call the traditional funding model, or in physics speak, this is the standard model of funding. And you may think of it as, gee, early on, I'm working on the science. They're in the left, the light blue. And working on the science is often supported financially by grants. And I think you're probably quite familiar with that. But then when you want to graduate beyond the science to proof of concept, you may need some outside capital for the first time. You may be taking now your invention out of the laboratory to show that you can actually make a gadget, a device, a drug. And so you'll need to raise a little bit of money to do some experiments or some work or some engineering, typically raised from what we call F&F, or friends, family, and fools. So that will be a modest amount of money to do some private work. And then you'll need to do the serious preclinical work. You'll need to do animal studies typically. And now we're talking about hundreds of thousands of dollars. That traditionally was thought of as the angel world. And after that, when it's time to do clinical work in human beings, then you might actually go to venture capital for the $1 million plus to run various clinical trials. This is the most sort of fundamental model of how a company might go, how a startup might go from the laboratory out into the marketplace. But I have to tell you, this is something of an oversimplification. I'm not really sure if the world was ever exactly like this, but it's really not anymore. There have been some changes in the last decade or so that I think are important to understand if you want to launch a company. The world has changed, and a couple of gaps have shown up in this neat arrow that I drew of funding. On the left, it's very hard these days to get from grants to the money you need for proof of concept. I mean, grant money shrinks and grows with the administration and various programs, but it is increasingly competitive. Let's face it, there are ever more smart people competing for those grants. So it's very hard to get the money you need, and the proof of concept gets a little more expensive with each passing year. So that's a challenging gap to fill. But perhaps more importantly, and what I'll talk about to a greater extent, is this gap on the right. There's been a real retreat from venture capital, retreat by venture capital from the very early stage investing. And whereas a decade or more ago, VCs were often investing in very early stage med tech, putting in $1 million for early work, that's not so true anymore. And I think personally, there are two reasons for this. And now I'm going to mix a little opinion with fact. I mean, the fact is that they've retreated. The data show that they're not funding the early stage stuff. But in my opinion, there are two reasons. There's what I call a good reason and a bad reason. The good reason is that venture capital funds have just gotten much bigger. I mean, the world is just awash in venture capital now. The stock market is way up, as everyone knows. It's very near record levels. And that makes a difference for venture. You might think it's unrelated, but the world of finance, it is very, very closely related, because institutional investors, to balance their portfolios across various asset classes. So as their publicly traded equities become more valuable, they need to reallocate from the publicly traded equities to venture. So there's lots of money available. So a VC fund like Third Rock here in town, says a VC firm says they're going to raise another fund, and they make an announcement, and the next thing you know, they've got $600 million signed up for that fund. And you know, if you've got a $600 million fund and you're thinking, I'm going to invest in 20 or 30 companies in this fund, then that means you're going to put $20 to $30 million into each of those opportunities. So you just can't bother to look at $1 million deals. So there is less attention being paid by the VCs to that. And I call that the good reason, because it's success on the part of VCs. There's more capital available. I mean, that's sort of the happy world. But the bad reason, in my opinion, is that I think the VCs have become more risk averse, frankly. I think they are less inclined to go into the higher risk earlier stage things. I think they were burned a few times with exits that did not earn the return that they expected. And from what I see, they don't have the appetite that they used to for the early stage stuff. So the world has had to adjust, and you as an entrepreneur will have to adjust your fundraising plans. And on the left, you're going to have to work harder at friends, family, and fools. You're going to need to collar Uncle Ed at Christmas dinner and see if, you know, he and his friends might put up a little money to help you with your early stuff. The angels are not moving earlier stage to help with that. So that's why you have to work harder at the F&F. The angels are, however, moving further to the right into bigger deals. And I think that gap that I showed on the previous slide is now mostly being filled by what I would call organized angel capital. And this is a little different from what angel capital used to be in the 20th century. In the 20th century, angels meant wealthy people who got together for dinner in the evening and listened to your pitch. And if they liked it, they'd open up their checkbook and they'd write a check for $5,000. And you'd hope to do that 20 times and get $100,000. Now there are some very serious organized angel capital groups, mostly on the East Coast and the West Coast. We don't yet see a lot of it in the interior of the country, though there's some. And they operate kind of like very early stage VCs. They'll have paid staff. We have this, for example, at Mass Medical Angels and at Launchpad. We have paid staff. We do a rather rigorous due diligence. We'll syndicate deals, and we'll be putting in several $1 million. And we'll look, if we can, to take that deal all the way to the far right, to what we call an exit, which is either a strategic partnership, an acquisition, could be a public offering, although in med tech that's not terribly common. Acquisition is more common. And we are less often working hand in glove as we used to with the VCs, where there would be a handoff, if you will, from the early stage angel funding to the later stage VC funding. Nowadays, angel capital rarely precedes venture capital sequentially in a financing of a company. It used to happen all the time. It used to be the standard model as I introduced it, but much, much less so today. Still happens sometimes, but much less so. And that's because there are two giant risks that we, if I put on my angel hat, I'll say we, the first person plural, we want to avoid a couple of real risks that have hurt us in the past. The first risk is that the VCs do not come in afterward. And we call this financing risk. And in truth, we just hate this. We completely hate this. we're in the business of taking on technical risk. We're going to pay for you to do some experiments or for you to do some device development. And we realize it may not work out. It may fail. What worked in the mice may not work in the rabbits, and so on and so forth. And that is the game we play. But we'd sure like to think that if the experiment does work, that the VCs or somebody will finance that to the end. And given the reduced appetite by VCs for early stage medtech, this is a risk that has hurt us sometimes. So we want to avoid that, and that's part of the reason, again, that we want to go all the way to the end of the deal. But the other risk is that the VCs do come in afterward, and that we call those bastards risk, because they can negotiate some very unfavorable deals with the early investors. And there's all kinds of casual expressions used for that, you know, taking a haircut and so on and so forth. And this I've seen personally. You know, we at Mass Med Angels did a really interesting deal to develop an anesthesiology drug a few years ago. It was really terrific. The idea was that it could replace propofol, which is a very common and frequently used drug, but has occasionally some, you know, nasty side effects. And we think that there's an appetite for an alternative to propofol. And we paid for the preclinical work in beagle dogs. And as planned, the beagle dogs went right to sleep. And fortunately, as planned, they also woke up when they were supposed to. So we were quite pleased, and we did indeed get VC financing for the human clinical work. And the VC said, wow, this is great. This looks really promising. And we will fund this clinical trial, $20 million, whatever it was. And we're thinking, you know, we'd like to come in at about $1 a share. And we said, hey, wait a minute. We went in at $1 a share before this was de-risked in the beagle dogs. And they said, yeah, no, that was really helpful. We're really glad you did that. You know, thank you so much for that. And we were thinking $1 a share. And that's where the deal was struck. And I have to tell you, we did not hold it against the entrepreneurs. They were trying to do the best they could for us. They wanted the VCs to come in at $1.50 or $2 a share. But he has the gold rules, and the VCs could make those rules. So we didn't hold it against the entrepreneurs. And in the end, in this case, everyone made out fine, as this drug is succeeding nicely. And so I think it'll all be okay. But because of that, the two parties are thinking about different kinds of deals. The angels are thinking, is this what we call angel friendly? That is to say, can we finance this to the end? And the VCs are thinking, I want a large deal. I want something where I can put 20 million to work and get 100 million out. So with exceptions, generally the angels and the VCs are looking for different investment opportunities. So that means that for you, the entrepreneur who's thinking, I have something here, you should know who you are and what kind of investor you're seeking. That means you have to have, at least back of envelope, some kind of capital plan. How much money do I need to get to market? I'll refer to that again a little bit later in this talk, but the tendency is for an entrepreneur and for an academic, who both have this mindset, to think, how much money do I need now? How much is this experiment going to cost? It's going to cost $500,000. That's how much money I need. But the investor is thinking, how much money do I need to exit? So you should think, what kind of play is this? Do I need $2 million, $3 million to develop a medical device that I think might then be acquired by Medtronic or Johnson & Johnson or Cook Medical or somebody? Or is this a $40 million play? In which case I should be looking at a different investor. So that's what you have to think about. And I would say if your capital plan is in the single-digit millions, that's probably an organized angel play. If it's in the double-digit millions, that's more likely to be a VC play. So think about that. Whom do you wish to approach? What kind of investor are you looking for? And then you're off. But how do you do that? Now that you've figured out whom you should be speaking to, how do you do that? Well, first, I would highly, highly recommend that you get a warm introduction, meaning a friend of a friend or a link or some personal connection. You would think in a very competitive world like finance and investment that doesn't matter, but it does just because the volumes are so great. As I'll tell you shortly, we see lots and lots and lots and lots of proposals every year. So we don't actually look at everyone, frankly. And if an introduction comes in from someone I know, then I will at least look at it. If I get an email from Chuck and he says, Eric, thanks for talking on Thursday, here's a really interesting one for you, I will at least look at it so I can respond to him and say, oh, I liked it or I didn't like it or whatever. But if it comes in over the transom, I may or may not have a chance to look at it. That's the lower priority one. So do your homework, figure out which firm is right, whom you might know in the firm, and then whom you might know who knows somebody. LinkedIn is terrific for this. You look up the firm or the organization, you don't know anybody there, but LinkedIn will tell you that your college roommate's sister is married to somebody, so on and so forth. So it's extremely useful to do that. It guarantees at least a look, which you might otherwise not get when we receive so many unsolicited pitches. Understand the investment sequence. I'll take you through this now. What do they do on the other side of the curtain? How do they process these pitches? First, there's a scouting step. This could be a person, a scout, or it could be a scouting committee of 2 or 3 people. This will be someone from the organization who wants to check out what you're doing. It looks kind of interesting, wants to ask you some questions, wants to hear about it, maybe wants to see some exhibits, see some data, and so forth. They're going to report back to a screening committee. The screening committee is a little more formal than scouting. Anybody might be a scout, but a screening committee will have particular members who have that responsibility. And they will be sifting through the reports that the scouts bring back and deciding which are the promising proposals to bring to our investment committee, which could be a subset of the whole, or it could be the entire general membership, but is the group that makes the decisions about which investments it pursue.
Say, Eric.
Yes.
Sorry to interrupt. This is Jeff. Say, can you say a word or two about what stage the intellectual property should be in as we start these kinds of conversations, whether they're to the friends and family and the Fs, or to the scouts or to the angels, and why having a strong position there is actually a good thing from their perspective?
Yeah, IP is absolutely critical to us as investors. It's one of the things we will use to evaluate an investment opportunity. We have to be convinced that you can defend your business. Now, sometimes in the world at large, there is defensibility that is different from IP. That could be strengths of particular companies, and I'm a strategist by background from Boston Consulting Group. But in the world that we're talking about in our meeting today, that usually is IP. It's usually some scientific discovery and advances. So we want to believe that your IP will protect you. So we do want to see that you have an IP plan that we have confidence in. Now, your question, Jeff, I'll try to address quite directly. What stage? We would like to see IP filed and an understanding with the owner of the IP, which could be the university, that you will be able to license it under favorable terms. In the ideal world, you have a license to the IP. The entity in which we'll invest has the license to the IP, but sometimes not. You get into a classic chicken and egg thing where you can't license the IP until you have money. You can't get money until you have the IP. So what we often do is step in and work with the university and say, let's plan to execute this together at a close. Let's figure out the license terms. Let's negotiate that license, and the license begins when the investment closes, and we pay you the upfront licensing fee and so on and so forth. We generally do not invest in companies that even the early startup companies that have not licensed the IP yet, or have not agreed to a license, let us say. An option on a license is interesting, and we'll talk to you, but we're going to have to figure out those terms before we make the investment. We don't want to give you a whole bunch of money and then you can't reach a license agreement. So that needs to be done. Now, there's a different question. I think that's what you meant, Jeff. But a different question is what stage is the IP itself? And in the ideal world, we'd like to see an allowed patent, but we don't usually expect that. We expect that a patent has been filed, and we hope that there's been some office action, so we have some idea of how likely it is to be allowed, which claims will be allowed. But we'll look at those patents ourselves and make our own assessments. A provisional patent is not that attractive to us, frankly. That's sort of creative writing and not so useful. So we'll try to convert that to a strict utility patent or composition of matter or whatever as soon as possible.
Excellent. Yes, thank you so much.
Sure. After the investment committee has said, yeah, this is one we really like, thank you for bringing these few opportunities, but we really like this cardiovascular stent idea. There'll be a due diligence process. And this will typically take at the least some weeks and perhaps months. The investors will examine the IP, as I've just been discussing. We'll look at your data, we'll look at the market, we'll talk to the users who might be clinicians, let's say. The buyers might be hospitals. There could be different parties. The hospital buys, the clinician uses. We'll want to understand pricing, reimbursement. We'll want to understand management, make sure that you have the skills that we think are needed to succeed. And then finally, we'll negotiate terms. And terms obviously include perhaps primarily price, but includes a bunch of other things too. It includes rights and responsibilities, things that we call drag-along rights, which means to what extent does a majority get to bring along a minority with particular shareholder actions. Tag-alongs, which means the minority has the right to join the majority. There are liquidation preferences, all kinds of terms to be discussed. Membership of the board is perhaps the second most important one after price. So lots of things like that, and then a closing. And you should expect that the closing would be, maybe 4 to 8 weeks after an investment firm has decided they wish to invest in you. And obviously working backwards, the scouting, the screenings happen before that. So it is a lengthy process. It's different from friends, family, and fools that way, who might like what you're doing and, again, open the checkbook. Now we're talking about millions of dollars. So people are careful with their millions of dollars. So you may need a different story or pitch for these different circumstances. And I'll talk about that a little bit in a minute, but the important thing for you to think about is when I'm meeting with one of these folks, is it a scout, is it the investment committee, what's the length of time we have, and what's the amount of detail that's appropriate? So you're not necessarily telling exactly the same story to everybody. You may need different pitches for different circumstances. Where we're going to go next is to talk about that pitch. But I do want to, let me finish the sentence, and I noticed your hand up. I do want to tell you that this is a difficult path. It is very competitive. The funnel narrows in an extremely intimidating fashion. About 1% of applicants get funded. And I looked up these numbers for my last talk. At Launchpad Ventures, I had the numbers not for 2020, but for 2019. And we received 1,200 pitches or proposals for investment in 2019. And we thought, I don't know the exact number, but something like a couple or 300 actually worth scouting, worth checking out. So again, the majority were not even worth checking out. But we scouted, let's say 250 or 300 of them. A minority of those went to screening. And of the 1,200, 33 were invited to present to the investment committee. And of those, we invested in 12. So these numbers are easy for me to remember, the first and the last number by heart, because 1,200 pitches resulted in 12 investments, or exactly 1%. I'm also a member of Sky Ventures, and I looked up the numbers there for 2020 because I was able to get them recently. We entertained there last year 1,800 startups with proposals. 350 were scouted, 24 were invited to present out of 1,800. We made 4 investments. It's 4 investments out of 1,800 pitches. So it's a tough show, but I'm going to help you figure out how to do a good job of it. That's what's going to come next. But Guy, I think you had a question?
Yeah, thanks. In the terms, you mentioned board seats, right? I was wondering, and maybe you'll talk about it later, but what sort of advice you could give to entrepreneurs who, you know, when you think about bringing people onto your board, you're obviously giving up some control. Kind of talk about that and what we should be thinking about.
Sure. It's very common for a board of directors in an early stage company, when it receives outside investment for the first time, to have a board of, let's say, 5 people, of which 2 might be designated by the founders and 2 designated by the investors, and then a 5th director who is independent. What you'd like as the entrepreneur is to have 5 people who can really contribute to the success of the company. Now, to some extent, you know, the board members are representing the owners, which includes both founders and investors. So to some extent, the board of directors' job is to oversee management, to make sure the right things are happening. And you can be sure they'll do that. But it would be wise to make sure your directors are also contributing to the success of the company. So you'd like investors who know the market, among your group of 5, and it's not necessarily 5, although I would say you need an odd number of people, and 7 starts to get unwieldy. But you want to make sure you have people who understand the science, people who understand the clinical application, people understand the business. So those are 3 things that I'd say you want to make sure you have represented on your board. Have people who can introduce you to the resources you'll need. That could be clinical research organizations, it could be customers. Make sure your board members are pulling their weight and not just watching you, but also contributing to you. That's the advice I would give to entrepreneurs. Is that helpful, Guy?
Yes, thanks so much.
Sure thing. Okay, now, so we're going to talk about the pitch a little bit. So here's the question for you. I don't know if anybody will be brave enough to try this. Well, why are you doing this in the first place? You know, what's the objective of meeting with an investor? You're going to meet with an investor, you know, you're new at this. What are you trying to accomplish? Okay, I'll answer it for you. It's a little bit of a trick question, because I thought somebody might say, well, the objective of meeting with the investor is to get investment. But that's really not true. With one exception, your objective is to get to the next meeting. The very last meeting will provide investment dollars. But as just described a moment ago, it's a sequence. It's the scouts, and then it's the screening committee, then it's a general investment committee, and then it's the due diligence committee. And each time you want to just make sure you've convinced your audience that it's worth going another step, that it's worth their while to spend time to see another card. It's a multi-meeting process. So what you want to get out of it is not that the person at the end says, yeah, I'm ready to invest, but that the person at the end says, wow, this is an interesting opportunity. I want to hear more. I want to keep going with this. And you'll get increasingly kicked upstairs, again, possibly with a different agenda each time, but to get the boxes checked off to where you finally get that final approval. So what are they looking for in this pitch? Well, some key rules. Know your audience. Whom are you going to speak to at this meeting? You should make sure to find that out in advance, and if you fail to do it, place a telephone call and get that straightened before you sit down, because you want to get the levels of science and finance right. If you're meeting with a scientist who works in this field, you can have a completely different talk than if it's a scientist from another field, and that's a different talk from someone who's a non-scientist, but let's say finance. The finance person may want to know more about the costs involved in the reimbursement, and how much money it will take, and whether you need to build assembly machines, or this is hand assembled, or whatever it is. So, so know who your audience is. Know the point of your pitch. You know, what are you trying to accomplish today? Remember, you're trying to get to the next meeting. So what is the question that your audience has today that's going to make him or her say, yeah, that's right. I feel satisfied, and I'm going to recommend them to my colleagues for the next meeting. So again, make sure you're getting the levels of science and finance right, so that you're answering those questions. Do not ask for a non-disclosure agreement. This is maybe the most nuts and bolts advice I'm going to have for you in this talk. And this is perhaps going to be a surprise to you because you think, gee, this is kind of secret stuff. But we don't sign non-disclosure agreements. I'll tell you that right now. We investors almost never do. There's some exceptions to that, some exceptions to almost everything I have to say this afternoon. But 95% or more of the time, we will not sign non-disclosure agreements. We don't want to do that. It just puts us at risk. We see a lot of different pitches. We're going to see people who might compete with you, and we don't want anyone ever to accuse us of having compromised confidential information. And our honor is really important to us. We have to be trusted. We don't want anyone ever to be able to say, did they find out that confidential information from you? So we're going to insist that you don't tell us confidential stuff. And it'll get different when we're very late in the process. Then, we might need to look at things that are confidential. But that is quite late in the process. And you make yourself look bad if you ask for a non-disclosure agreement for two reasons. One is, as per Jeff's good question earlier, we want to believe that you have some protection here, that you've got IP protection, or in some cases otherwise, but in general, IP protection, that there is a patent or a patent in process, there's a license or a license in process, but that there are legal means to keep people from stealing this idea. And if you're going to hint that by describing the idea, it's no longer safe, then that doesn't sound like a very compelling investment opportunity. So that makes you look bad. And the second reason it makes you look bad is because I just told you that we don't sign NDAs. So if you ask for it, that makes me think you don't know this game. You're a rookie at this, and maybe I need more experienced entrepreneurs. So that's my nuts and bolts advice to you, no non-disclosure agreement. And then I'm going to give you my perhaps most important piece of advice of the day. That is to tell a story. A story is much more compelling than any checklist. And I think if you were to take one message away from what I'm telling you this afternoon, it's that we see so-called decks after decks after decks full of slides after slides after slides. None of these actually are slides or decks. It's from 30 years ago. But we see zillions of those, and your eyes glaze over when you see the millionth market size slide, competition slide, blah, 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 blah. What we want to hear is a story about why this is a great investment. And by story, just so you don't misunderstand, I don't mean that it has to be a personal story about how your aunt suffered from this clinical condition. It doesn't have to be that. It has to be an investment story about why this is a great opportunity. I mean, we've invented something that's going to be really valuable. This is going to change the way people with this condition are treated. And everyone's going to want to get this. It's going to make a big difference in diabetes, and a lot of people have diabetes. It's going to be worth a lot of money, and you can get in on the ground floor now. And if you miss this opportunity, you're going to rue it the rest of your life. So we investors are motivated by a mixture of sort of fear of missing out and greed. So you want the investor to leave this meeting thinking, wow, this is a good one. I've got to get in on this. So think about your story. What makes this exciting? And convey that excitement and emphasize what's important about it, de-emphasize what's not important, so that excitement is maintained. A checklist doesn't do that. If you think here's this point and that point and that point and that point and that point, I mean, it just, that's great. And I think he was a nice young man or young woman, but it doesn't make me want to race back and call my colleagues and say, we've got to get these people in here. So think about what your story is. Don't think of it in terms of a checklist. Full stop, most important message. But now I'm going to go on to some nuts and bolts again. There is something of a checklist. I've told you it's not important. I've told you to think in terms of a story, and I strongly believe that. But to do a good pitch, you want to make sure you're covering some important things. There is a mental checklist we have of 10 or 12 items that you should be able to answer. And for all investors, this list is about the same. For some people, it'll be 10 items, for some 11, but not because people are leaving things out, but sometimes people are just collapsing 2 items into one or dividing it into 3. I mean, they say physicists are all lumpers or splitters, so you have to decide, which of those you are. But these are the things that an investor will want to know before he or she invests. What's the opportunity, the problem, the pain point? Why do I care about this? The very beginning, why do I even care that you've invented this neat thing or you discovered this neat thing or you have this gadget? Why should I care at all? And the answer presumably is because there's something that doesn't work well in our world here in 2021. And I may have something to that for that. Number two, I have some solution to the problem. And you'd be surprised, but sometimes entrepreneurs even leave that out of their pitches. But I want to know, are you selling me oxygen or aspirin or jewelry, as a colleague of mine says? Something that's needed for life, or something that's really valuable, or something that's very, very, very nice to have. What is your solution? What data do you have in support? Is this real or is this vaporware? And even vaporware can be okay. You can say, I don't have much data yet, and that's what I need the money for. And that's okay. Then tell me the story. Why do you think this is promising without much data? What leads you to believe this? So again, you want to be honest, and that will affect, how early you are, how late you are, valuations. But be straightforward. What data do you have? What intellectual property or other protections do you have to defend this? That's right up there. So, Jeff had asked the right question. We need to know that, because if anybody else can do this, then chances are that there are more powerful companies than you three guys coming out of Jeff's lab. So we want to know what your protection is. How large is the market, and how do you define it? The definition part is kind of important. I've seen in the last few weeks a couple of pitches that I thought got that so terribly wrong. I saw about 3 weeks ago or so somebody coming to me with a really neat little thing for blood typing. Blood typing is kind of complicated today, surprisingly. And he had an idea for a simple, cheap, portable blood typing device. And he said the blood transfusion market is $10 billion a year. And it might be, but most of that is blood. It's not blood typing. So the blood typing market is a fraction of that. I saw another company recently from Europe that is working on risk screening for mammography. And they did the same sort of thing. They said the mammography market is $40 billion a year. And yeah, it is, but that market is mostly for taking X-ray pictures of breasts. It's not for screening before the mammography. So they were unfairly and incorrectly defining this market as way, way larger than it is. And sometimes people do the opposite, and that can be equally unfavorable. So think about what the market is. Define that correctly. We do need to know how large it is, because that helps us understand how much of a business it is. Who is the competition, and how are you positioned relative to them? As a competitive strategist, I consider this sine qua non. You can be better in the life sciences and healthcare related things, and generally I would say three ways. You can possibly offer better outcomes, or you can possibly offer a faster, cheaper way of achieving the same outcomes, or you can possibly offer broader access. And any of those three can be quite attractive. I need to know that you're better at something. And that is very obvious to a business person, but not necessarily to a scientist. Because for scientists, novelty and innovation is very important. And indeed, that's correct. And I admire that so much, frankly. It is so important for us to advance human knowledge. And so it is a terrific accomplishment to learn a different way of doing things. But a different way of doing things isn't necessarily good business if it's not a better way of doing things. So make sure you understand that. Have some idea of how you're going to go to market. How does this get sold, and to whom? What are the economics of this business? How much does it get sold for? How much does it cost to make? Does this get reimbursed? Does it get absorbed as part of a procedural code? How does that work, and what are the financial projections of this business? And we don't expect that you're going to be very good at that. First of all, you're trying to make predictions, which, as Yogi Berra said, is especially hard about the future. And the other is we don't expect you're necessarily so financially sophisticated, but we want to understand how much money is this going to eat up before it turns profitable, how big will it get? Then please tell us about the management team. Who's going to run this company? Any advisors you have on the scientific advisory board will be important to us. A little piece of nuts and bolts advice about the management team. A couple of pieces about it, actually. One is I recommend, and this is opinion, it's not fact, but I recommend that you do not start your pitch with that. I mean, most people do, and it's a model, and some people even tell you to do that. But I'd say no. I mean, introduce yourself, as I did at the beginning of this. I'm Eric Evans, I'm from Boston, I'm an investor. But don't put up a slide with lots of headshots and what schools people went to, because that is really boring. And the beginning is when you have everybody's attention. They're listening to you. You're trying to get them excited. You're trying to tell them a story. Say, this person went to Stanford, and this person went to Ohio State, and then it's really, and this person's worked for Medtronic. It's really not interesting. Also, we don't know if that management team is relevant because you haven't told us yet what they need to do. So first, I want to understand what you're trying to accomplish, and then I can assess, is this the right management team or not? So I would say, it's my opinion, don't start with the management team. Tell us about the management team after what you're going to do. And the second nuts and bolts thing is to be candid about any gaps in the management team. It's common for a startup to not have all the talent it needs. Your investors can help you with that. This is one of the things we do when we launch companies. We try to find that director of clinical development or whatever's needed. That's fine. We can find those people for you. What's going to lessen our confidence is if you say, we've got everything we need here, and we say, there's nobody here who's ever brought a product to market before in his or her life. Then we think, they don't know what they don't know. If you come to us and you say, we know what we're good at, we know what we're not good at, maybe you can help us find X, Y, Z, we're there. Number 10, capital needs, immediate and total. I referred to that a little bit earlier. We need to know how much money this is going to eat up, not just the $500,000 you need now for this year's experiments, but how much capital does this consume in total before it doesn't need any more capital. And use of proceeds. This capital you're asking for now, what are you going to use it for? Exit plan is really important. We are not building a business so that you can have a great job running a business. We are giving you money so that you can give us money back, more money back. What the investor wants is to give you $2 and you give him back $20 as soon as possible. So tell me what your plan is for giving me back a multiple of the money I gave you, PDQ. And then finally, deal terms. What percentage of the company, what price are we talking about? This can be high level, it can even be ranges. But it is important to have this very vaguely at least, because we hate to waste time with someone who has some kind of crazy notion of what the deal is. And we can get sucked in listening to your fascinating science. We like that. That's why we do this for a living. But then you come back and you say, I thought I'd sell you 10% of my company for $6 million. And I just say, why do we just spend 5 hours in conversations with these people? That's just, ridiculous. So we do want to know a little bit about that. So this is a lot of stuff. One of the things you might find a little intimidating, one of the things you might be thinking now is, yikes, I thought I was ready to start a company, and that's a lot of stuff that I don't have yet. So you're wondering, geez, Eric, do I need all that? Well, yes, eventually. Every pitch doesn't need all of that, because remember, you have different pitches for different circumstances. You have your meeting, you know who your audience is, you know what you're trying to accomplish. So you don't need all 12 of those in every pitch, but you do need to know the answers to those 12 things, because somebody in the meeting about the science might say, wow, that's really great. You got this integrin inhibitor that exactly affects the molecular pathway that we're trying to take, and that'll make the difference in the fluid in there. And they say, how much capital are you going to need for this anyway, Susan? You can't come back and say, I have no idea. You have to say, well, we're thinking $5 to $7 million. We can talk about that at the next meeting. So you really need to know those 12 things, or you're not ready yet to go out to investors. And then ask yourself, does it fit into this story? What was my story? Does this fit in? You don't need one slide per point. And this is kind of a recapitulation of my earlier message to tell a story. Too often people are putting together collections of slides, and they've got, as I said, their market slide and their competition slide and their IP slide and so forth. And that's not a good way to go about it. I mean, just sometimes 2 points can collapse into one slide. Maybe there's a market today and one party's got all of it. So your market, your competition slide are all one. You say, you know, there's one provider now of this kind of tube or device, and they sell $500 million worth of it a year, and blah, blah, blah. On the other hand, your IP story could be complicated, could take a couple slides. So, you know, take the time you need, remember what your message is, use active headlines in your slide deck. Don't have a slide that says market size, and then I have to, you know, read through the slide to figure out what it is. Have your headline say the market is over $5 billion. Say competition is fragmented, or say competition is dominated by Johnson & Johnson and a couple of smaller companies. Ideally, I can go through your slide deck and just read the top line, the headline of each, and get your story and know what you're trying to tell me, and get to the end of that and think, well, you know, this is pretty interesting. Then I'll go back through your deck and see how the exhibits actually support the points you're making in the headline, and see if I believe you or not, but I've gotten your story from the headlines. So have a narrative thread, make sure, you know, one slide follows logically from the other, and brings the investor along from thinking, you know, it's kind of curious, what is it, to thinking, wow, this is an investment opportunity I better not miss. What I'd recommend, everybody has their own style, but I'd recommend is, you know, write the story first and then write the slides. Literally take one page and write, you know, 10 or 12 sentences and say, this surgery is very dangerous these days. We have a way to do it minimally invasively. Nobody's done it so far, blah, blah, blah. And tell your story and then say, okay, now these are the slides that I need. So that, I think, produces a more compelling deck. You know, moments ago, I was telling you about how incredibly competitive this is, how the funnel narrows from 1,200 pitches to 12 investments. But I've got to tell you, 60% of the decks I look at are just crap. So those are not considered. And we investors realize that some of those 60% that we just reject out of hand may actually be pretty good ideas. But we can't try to pull those ideas out of a lousy deck. We've got to look at a good deck, be excited, and then test it to see if it's for real. So you want to be in those good decks. So, you know, write a good story, and then support it. It's kind of like, you know, sort of making a movie. You can't make a movie without a good script. You got to have a good script, and then you pull in all the elements and try to make a successful movie. Similar, you can't just, you know, buy Microsoft PowerPoint and make slides and then think you have a story. You start with the story, then make the deck that supports it. And let me now just wrap up with a couple of things, and then we'll take a few questions if there are any. So some final points. This is one of my little memes. Good science does not necessarily make a good product, unfortunately, for all the good scientists out there. And a good product is not necessarily good business, and good business is not necessarily a good investment. And you may follow what I'm saying there, or you may not. So I'll illustrate that a little bit. There's some great science going on today in predictive biomarkers. I look at this a lot, and I think it's really interesting. And I think it's wonderful. I think not only is that advance in human knowledge wonderful, I think it will be useful one day for learning how to prevent and or treat various conditions. But it's not necessarily useful today. There are various startups I see, for example, say they have a good predictor for Alzheimer's disease, or they have a good predictor for Parkinson's disease. And I've seen these. I've seen a bunch of these. But, you know, what do I do with that as a business? We don't have good therapies today for Alzheimer's disease or Parkinson's disease. So I'm not sure what I sell to whom. So the science is terrific, and I think it will lead to the improvement of the human condition eventually. So I think it's just terrific, but it's not a product there, really, not something that I can sell to somebody. I could also have a good product and still not a good business. And I've seen that a lot of times too. And that happens a lot in med devices, particularly hospital supply kinds of things. I see that I ran a catheter company once. Catheters have lots of room for improvement, frankly. I mean, central lines are hard to place. There's risk involved. Peripherally inserted central catheter is also a difficulty. There's with proper placement of the distal end. All catheters, indwelling catheters, are problems with infection. So there's lots of room for improvement in catheters. And I see good catheter ideas, but it's really hard to make a good business of that. You know, catheters today are sold by companies who sell vast catalogs of hospital supplies to hospitals. And they come in and they've got, you know, a catalog that's inches thick, to the extent it's on paper, but, you know, a huge catalog. And they're working out deals with the hospital. They're bundling various things, and, you know, this costs less if you buy more of this and so forth. And the hospitals, for their part, are trying to get their suppliers down to fewer and offering to give them larger chunks of business for price discounts. You cannot show up at a hospital and say, I've got a catheter for sale. I mean, it's not just that you won't do well. I mean, you can't do that at all. You're not going to get an appointment to sell a catheter product. So that's hard to make a good business out of. I mean, it means you have to ally with one of the big companies early on. And that can work, and it has, and I made it work with a catheter company, but it's hard to make a good business of that. And then finally, you know, a good business is not a good investment, meaning if the terms are not attractive to the investor, then he or she will just, you know, wish you good luck. And we need, as I was saying earlier, to get a lot more money back than we put in, or it's not attractive, because, you know, most of these are going to fail. So think of it from an investment point of view. To the investors, you're pitching an investment, not science, not a good product, not even a good business, but a good investment is what you want them to think. And put on your investor goggles and say, what does this look like from the investment point of view? And then finally, I would say, you know, while the investors are screening you so carefully, you can also be screening them, because bad investors can really be a pain in the neck. They'll just make your life difficult with demands, making things difficult to do, getting in your way. But good investors are worth more than rubies. You know, the question was asked to me earlier, what do you look for in a board of directors? Directors and the investors will have some overlap, but with investors, as with directors, you want people who can contribute to your business, people who know the business, who have good ideas, will be helpful, who make introductions to people, whether it's customers, suppliers, or whatever, people who can help you make a better product, create a better business. So while they're screening, you should be screening too. So I wish you all the best of luck with your entrepreneurial ventures now and in the future. I do not have a hard stop at 5 o'clock. So I've tried to steer this to end now. I can stick around a bit longer and take any questions if there are any.
Well, thanks so much, Eric. That was a great talk, just very practical for what we need. Great information here, so I appreciate that. There is one question now. For those of you who have to leave at 5, I put the survey in the chat. Please take 2 minutes to fill it out. It helps us direct this to what you want. So with that, Alex, if you have a question you want to unmute, just unmute and ask the question. Alex, go ahead.
Yeah, thanks for the great talk. So I know that a lot of us, if we're spinning out our research, we're really attached to it and we kind of see it as our baby. So I don't really like the idea of immediately selling it off to a large company and just putting it in the hands of someone else. So how can we convince investors that we have a team that can really carry this as a company without relying on acquisition as an exit strategy?
Well, there are a couple of things we shouldn't get mixed up about. One, because there's 2 stages there that I think you're talking about, Alex. One is you're spinning this invention out of an academic setting, starting a company, building it, maybe even going to market. And the other is the exit by acquisition. So there are a couple of different things. My answers are different for those. You do want to convince the investor that, hey, you're the team that can make a go of this. Perhaps, and you may not. Other people have different attitudes. Some people just want, George Church wants to spin things out, you know, not get involved in any of these. But it's your baby and you want to run this. So you can. What you're saying, I think, is you don't want the investors to put in their own management. You want to be managing. So you need to convince the investors that you are assembling the right talent around you. And then we investors actually like to keep management in place if we can. I mean, different investors have different attitudes. I think organized angel capital is much better about that than the VCs, who very often have their stable of entrepreneurs and residents, and they just want the IP, if you will, and then they'll create the company. But I think if you assemble the right talent around you, you can hold on to your baby and run this company and build it. So I will be very encouraging for you on that end, the launch of the company and building it. However, regarding the acquisition, we are looking for an exit. We don't really want to invest and see you run this company for 20 years and never give us our money back. This wasn't charity on our part. So that is a tough one. I think you do need to tell the investors the way that he or she gets his money back, and that's not, lost forever. Now, in an acquisition, you can often continue running the company. I mean, the acquirer may still let you run it, but not necessarily. You can't count on that. But at that point, presumably you've had a good run. You've been running this company for 4 or 5 years. You built something really interesting, and now they're saying, take your $75 million, please, Alex, and go start another company. And presumably that's attractive for everybody.
Awesome. Thank you so much.
Great. Chrissy, you want to unmute?
Yeah, I had a question. Thank you for the talk about how we can do our due diligence in evaluating investors. Are there metrics we can find online without, just trying to find out everyone else's story when dealing with them?
Yeah, I think there is a fair amount of due diligence you can do online. Some of the diligence, you'll start with diligence on the firm or the organization. What kind of investments have they made? How have they contributed to those companies? And then you'll start with the individuals. Start in on the individuals, and again, you can use LinkedIn and say, who do I know who knows this person? And then you're saying, gee, were they helpful? And, you'll find out that your friend knows someone at such a startup that was supported by Long River Ventures, and you'll ask them, was Long River Ventures helpful to you? What'd you get out of it? So I think it's it's the usual way. You start online and then work the personal network. I guess there's a third step beyond that, and that is, in fact, meeting with the prospective investors. And then, you can interview them like they interview you and say, what's your experience in this? What can you do for me? So I think it's probably 3 levels of due diligence on the investors.
Okay, thanks. And I guess I'll go into my next one with that, because I'm wondering what we should be asking other people and how to find out on the negotiation side with the deal, like how to structure it. How can we talk to people who can advise us on that side before we start talking to investors themselves?
Yeah, it will be helpful for you to find people with that. I mean, I think investors are not unfair, cruel, cold-hearted people who will try to take advantage of you. But you do want to be informed because you want to know the questions to ask and what's the difference between participating preferred stock and non-participating preferred stock. What is a liquidation preference? So I think you need to find that somewhere. It's possible that Chuck and Jeff would know sources for that. I see Jeff nodding.
Yeah.
I mean, there's certainly lawyers who can help you with that for a fee, but I think they could probably help connect you with folks to get you started. And then by the time you enter negotiations, you should have some kind of legal counsel representing you.
Okay.
Chuck, can you mention a few Hopkins resources, Chuck?
Well, yeah, there are lots of, there's some great books that are really short ones, but Tech Ventures can probably help a little. And that's early on in educating you. Once you're in a company and start negotiating, it's not Hopkins, you're a third party. And so you can't expect Hopkins to bring the resources there. But early on as students in that, they provide mentors and things like that to think about. But as Eric was saying, you're going to need legal representation, and if you have good ones there. And there's a lot of startups that have gone on in the area. BME, we've got a lot of startups. You can talk to some of the colleagues and get some of their experience. And certainly I'd be happy to share some of those in a limited way.
Yeah, and I'd encourage you to get legal counsel early. They can be enormous help when you're starting up a company. And they'll help you, with the licensing from the university. They'll help you with the corporate documentation, incorporating in Delaware, and so on and so forth. And there are lots of law firms who are used to working with startups. Even the most Tony white shoe firms, Goodwin Procter here in Boston and others, will work for startups for deferred compensation. So you don't have to worry necessarily about having the money to hire the lawyers at the beginning.
And on Hopkins Tech Ventures, has deals with that, so they can get you some early, very good deals and where they recognize this. So we can talk to that. Speaking of tech ventures, Sam, do you have a question?
Yeah, thanks, Chuck. I was curious about situations. You talked about assessing a market size as a proportion of a unified market in those examples and in most cases. But say, for example, you've got a trauma and a surgery causing the wound that your product addresses. What's the room for creativity as long as you show your work where you're aggregating a couple of different relevant etiologies or whatever to, to correctly point to the market for your product?
Yeah, well, that's a good question, Sam. And every case is different. I think you want to be fair to yourself as well as investors and define the market as fairly and representationally as possible. I gave those examples of people I thought defined the market too largely, the blood typing and the mammography screening. Pulling something not from healthcare, but it just happened to me not long ago. And I also live in Switzerland and do a fair amount of work there. And because I have something of a consumer background, I was at Procter & Gamble for a while. I was asked by a Swiss candy company if I could help them with an issue. Very small family-run company. I had not heard of them before. There was a connection. They knew somebody who knew somebody. So I met with them, and they said they were the market leader. And I thought, what? I never even heard of this company before. And Switzerland is full of big candy companies. There's Lindt and Toblerone and all that. I said, how is that? And they said, we have 60% share in 1 centimeter chocolate squares. And I thought, can't somebody take a 2 centimeter chocolate square and break it? Something else. So that was sort of the opposite example. But I think, in your case, of course, I don't know exactly what you're doing. What I might present is 2 markets and say in trauma, there's a $400 million market. There's another $300 million market in surgery for this application, and total 700. But don't try to say we're doing all surgery, we're doing all trauma. But say when this happens in trauma, it's worth this much. When it happens in surgery, it's worth this much. And I think that's perfectly fair, and it gives a good view into the market for the investor. I think for you too as the entrepreneur, because among the things you might think is, do we enter one of those markets before the other? Do we enter them at the same time, you might ask? So I would do that. I would say it's a two front market.
And stay tuned for BME-X in early June. We have an analyst from a VC company coming in who will be addressing that to a bit. So a couple of quick questions on, and then we'll have to wrap it up. So Patrick, you want to ask, and then Guy, you'll.
Yeah. So first of all, yeah, thank you for that talk. Definitely learned a lot from this. I would say, just kind of listening to this, it seemed very much tailored towards a product kind of getting through the preclinical trials, clinical trials, and kind of moving forward with a drug. Would you have any major differences from what you've discussed today for a service? Because I'm actually working more on a drug development platform that would be interested in commercializing. So it'd be more of a service than a product. So I don't know what your thoughts are on that.
Okay, yeah, Patrick, yeah, well, you're very astute. I did kind of tailor this more towards products, whether it's med tech or biotech. Services are a little bit different. Most of what I said still applies, but it's a little bit different business. I mean, the dynamics are different. There's not necessarily the same issues around IP, although there can be. Services are harder for us to invest in. We look at them all the time, and some of my colleagues particularly love services because the exit is typically a little bit harder. When you have a device or a drug and it works, you can be pretty sure there's some big company out there that would like to add that to their portfolio. That is not as obviously true of the service. I mean, it can be true, but if you're saying, gee, I'm helping companies make their drug discovery more efficient with some screening service or something, it's not clear who would buy that. How do we get our money out? So that's a little bit harder for us to finance. The advantage for you, though, is you can do more self-financing often, or what we call bootstrapping. That is to say, you can start to offer your service and have a customer or two and actually money coming in that helps you fund the expansion of the business. The dynamics are a little bit different. It was astute of you to recognize that.
Yeah, thank you.
Great. Well, last question will be Guy, and then we will
So I don't know
end
if
it.
yeah, so I don't know if it's the same question or a different question, but my question was around physical products, right? You mentioned catheters versus digital products, right? Which obviously can be sold as a service, and how you look at that, whether your answer is different from the preceding one.
Yeah, that is, again, a little bit of different circumstance. I think the opportunity in digital is as big as in products. I personally tend to be a little bit more products oriented, but it's not true of my colleagues. Some of them it's the exact opposite. Again, I think the dynamics are a little bit different, kind of like services are different from products, but if anything, even more so. There's probably less importance to the IP protection in digital than in services, and in services less than in products, I think. So that's not as critical. Often you won't file any patents at all for a health IT product. It also can often be self-financed or financed a little more easily because you can have customers, early customers. Often the capital needs are not as great. So that can be pretty attractive in that way. Also, unlike the service business, it might be more like a product business in that there are often a lot of acquisition opportunities in healthcare IT. There are a lot of people who want to buy good IT applications, whether those applications for institutions, the Cerner and others who are doing, various electronic medical records and big institution-wide things, as well as consumer apps. So, and then you have Google and Apple and a million other folks for that. So there are a lot of acquisition opportunities. So they're good exit opportunities for the investor, not a lot of capital. So that makes it a little bit easier to finance. The hard part is defending those things usually. When we look at that, we say, wow, this is a good idea. Can't one of these companies throw a bunch of engineers at it and also do it? And depending on what your idea is, the answer might be yes or no. And sometimes your defensibility is not in your own software, but your library of files or data that allow you to do the machine learning or the AI or figure it out. And that anybody can actually write the program, but only you have the millions of mammograms or pathology slides or whatever it is that allows the healthcare IT to work.
Well, great. Well, with that, we're going to have to end. Eric, thank you for a tremendously informative and practical seminar. With that, I will let Jeff, sign us out. Yes, Jeff, I know that you get the last.
Well, I like everybody. John Duva, can you show us your 1-minute version of your question? I want to make sure that we get them all out there.
Oh, okay. And please take the survey if you have to leave.
And
it's
don't
in the
leave.
chat.
There is a wind up. But John, did you have a short version of your question?
Yeah, Jeff, thank you. I really appreciate it. It's quick. I'm just curious, Eric, and Eric, thank you for being here. But do you have a recommendation as to what the principal components are when deciding whether to pursue venture capital or to fund yourself and try to hold on to as much equity as you can?
I think you have to trade off ownership versus speed. Think about what your capital requirements are. I mean, if you're going to need $20 million, you're not as likely to have it. And if they're different scales typically, self-financing and venture financing. But if you're lucky enough so that that's not the issue, then I think it's speed. Will these investors make you be more successful faster? The old cliche is it's better to 50% of a large pie than 100% of a small stale pie.
Right. Okay. Got it. Thank you.
Great. Well, Eric, I want to thank you for a great talk and just add my thanks and applause. Really excellent. You took on a topic which, right from your title, we could all see that there's something really interesting here. And you showed us that it's even harder than we expected. Right? You showed us a 12-step program. I guarantee scientists know nothing about step 7 to 12, at least, right? And so it's good. Now we start to know what we don't know, and that's the beginning of the path to wisdom. So thanks, Eric. Really, really great. And also, by the way, just the storytelling within your talk is something that I think we all appreciated as well. And so you're really, you're doing as you're teaching. Eric, as a small token of our appreciation, I want to present you with this. This is the BME-X official trophy, as it were, and this one's got your name on it, and it's on its way to you by snail mail.
Terrific.
It will be when you send me your address, so just
Okay.
pop that in the email, and then the snail mail will be initiated.
Okay, I will do that.
Eric,
Thank you so much.
Really great. You really gave us a peek at how much we have to learn. We've got to practice, you know, and get this right. It's I thank you very much for taking on this challenge today.
Well, it's been my pleasure. I look forward to seeing some of you in person, I hope, before too long.
And it was exactly like I expected from the C3I. Thank you so much. It was right at the level for our audience, so really do appreciate it. And I'll just follow up, and it's great to be acquainted with you now.
Okay, my pleasure. So long, everyone.
Okay.